Welcome back to the channel. This week is a big one for markets. The Federal Reserve's September meeting is right around the corner, and Wall Street is bracing for a rate cut. The key question? Will it be the standard 0.25%? Or could we see a surprise big cut? Let's break it all down. Right now, most analysts and traders are expecting a 25 basis point cut. That makes sense. Labor markets are cooling, inflation is moderate, and the Fed wants to keep easing without looking panicked. But here's the twist. If upcoming data shows sharper weakness, the Fed could go bigger, 50 basis points or more. While that's not the base case, markets are leaving room for that possibility, and it could change the entire tone of the meeting. So how would markets react? A standard 0.25% cut usually supports equities, cheaper borrowing, lower bond yields, and more risk-taking. Growth and housing stocks tend to benefit. A big cut would likely spark an initial rally, especially in small caps and rate-sensitive sectors. But here's the catch. Investors might start asking, why is the Fed cutting so aggressively? That worry could trigger volatility or even a classic sell the news reversal. And remember, history shows that 40% of Fed rate cuts are followed by lower markets just 1 month later. So cuts don't guarantee a smooth rally. Beyond the rate cut itself, all eyes will be on Chair Jerome Powell's tone. If Powell is dovish, hinting at more cuts, downplaying inflation, and stressing growth support, risk assets could rally even more. Small caps, housing, and tech could all see a bump. But if Powell turns hawkish, warning about inflation or pushing back against aggressive cut expectations, markets could swing sharply lower. A hawkish surprise would likely hurt the sectors that have rallied the most in recent weeks. Lately, Powell has been more dovish than markets expected, which fueled rallies. Any shift back to hawkishness could catch traders off guard. Zooming out, here's where we stand. The S&P 500 just closed at record highs, powered by Fed optimism and strength in healthcare and small caps. The Dow and Nasdaq are mixed, showing sector rotation between defensive and growth names. Small caps have been rebounding, signaling investors are hunting for undervalued plays. But there are risks. Valuations remain stretched, tariffs could put pressure on inflation, and September is historically one of the weakest months for stocks. Seasonal volatility and portfolio repositioning could amplify swings. Here's what I'll be watching closely. The Fed's decision and Powell's press conference, of course. Labor market and inflation data. These will shape expectations for future cuts. Company earnings, especially in tech and consumer discretionary, since stretched valuations could lead to surprises. And finally, trade and tariff developments, which could influence inflation and global sentiment. In short, the Fed is likely to deliver a small cut with a cautious tone. But whether Powell leans dovish or hawkish will set the market's short-term direction. Expect volatility, sector rotations, and potentially sharp corrections if expectations aren't met. That's it for this week's briefing. If you found this helpful, make sure to hit that like button and subscribe so you don't miss the next update. Thanks for watching, and I'll see you in the next one.